Okay, great. Hey guys, thanks a lot for joining in to the GreeksCap webinar for the Kerala flood relief. We want to first of all just thank all the participants who have contributed and made their donations to the Kerala Chief Minister's Fund, as well as all the other places that you guys have chosen to donate to. I think that's a beautiful gesture on you guys' part, and we just want to do a little bit on our end and help you guys get into this topic of trading volatility with straddles. So without further ado, I just want to go ahead and introduce the three of us. My name is Prashant Malik. I am an options trader. I trade my own options book. A lot of you guys might know me from my tweets on Twitter on Worry Capital, and I'm here to try and help you guys understand the things that I do. I will go around and
yeah, hi guys, I'm Vishwesh. I'm also an option trader. Mainly, you can say that I trade, quantitative options. I'm associated with one firm in Mumbai, so you can say that GreeksCap is our, venture where we are trying to, do things for the larger group, for the trading community. And I'm there on Twitter. I guess most of you must be knowing. I am Vish Chauhan is my Twitter handle. So that's me. Alok.
Guys, my name is Alok Daria. I'm the third leg of GreeksCap. I basically trade options. I've traded commodities. I'm actually managing a managed futures business right now, a long short trading strategy. I'm also very actively involved in managing money on the options trading side as well. The three of us got together. I mean, since I don't know how many of you guys are on our GSR, but if you are, then you probably know a little bit about us in which way. So yeah, you guys have any questions? I'm on Twitter as well. My handle is ALKD1976. Yeah, it's a weird one, but that's what it was set up as, so that's what's meant. So anyway, that's us. Sean?
Sure. Thanks, guys. So what we'll do is, the way we've structured this webinar is, we're going to put up some slides up there, but we want to do a group discussion amongst the three of us for all those slides that are on there. And try and make it interactive, because we don't want this to be just us putting material out there and just talking a one-way with a one-way street. So we'll do a group discussion, and so you'll get to hear about ideas that each one of us has for the particular slides or the topics that are at hand. Options trading or any trading for that matter is very individual and personal. So you get to hear about what each of us think on different topics. So we'll do it in that format. So let's get started with our slides. I'm going to just share this on the screen here. I'm going to share the PowerPoint, right?
You have to maximize the PowerPoint.
Yeah, there you go. Okay, let's see, where are we?
Yeah.
So you guys can see the PowerPoint up there. It's a chat window. I need the chat window, right? So we can see people chatting. Yeah, there you go.
You bring it down. Chat window. In this.
We'll bring it here.
And
full screen.
Full screen, you will go on the PowerPoint. Lower right hand side.
Ah, there, yeah, there you go. Yeah, it's been a while since I've put up PowerPoint. All right, so this webinar is about trading volatility, and within volatility, we're going to take a subset of strategies, and the one we're going to do today is straddles. So let's get started there. One of the things about trading options is that there are a number of risks that you have to take care about. When you're trading direction with the futures or the cash market, you essentially have the risks of the market going up or down, right? So when you're trading options, you have several other risks that you got to take care about, and it's really about the direction as well as a few other things. Time is of the essence.
Definitely, I think along with the time, the most important thing remains is the volatility, and that is what it's all about. Options are all the function of volatility. And Straddle, I think, gives you the best indication about what market is pricing about the range. So, I mean, if you have an idea about the Straddle, then probably it can give you a lot of insight into the sometimes even what sort of a range you may expect, especially the early times.
Yeah, just a quick note on, you mentioned Straddles having a great point of view on what the market is expecting the range to be. A classic example would be, say, take a stock take two stocks that are trading at say around 1,000 rupees, right? Same lot size, same strike price, and yet you see that the option prices are different for the two underlyings, right? What really causes that is the market's expectation of an expected move on the two underlyings. Like, for example, say Reliance is 1,000 and say something like a Titan is 1,000. Titan, being a more volatile stock, will actually have Straddle's price in at a much higher price as compared to, say, a Reliance Straddle at the money. And the reason for that is market is expecting Titan to have more volatile moves. So the expectation is that a Titan can move 8% up or down, while Reliance can only move 4% up or down in a specific period of time. And that's really what drives. So volatility is really the key component that drives the value of an option. And a straddle is basically generally an option that trades at the money, right? So if the underlying is 1,000, the 1,000 call and put combined is basically what we call straddle. So the combined value of the straddle is what the market is saying is setting up the range for the expected time. So if a Titan straddle is trading at 80 rupees, the market is expecting the range between that day and expiry to be about 920 or 1,080. The same straddle on Reliance trading at 40 rupees, the market is saying the Reliance is probably expected to move in the 960 to 1,040 range. Right, and that's really the difference between the two is really what the expected volatility is that the market is pricing in.
That's a very good point that Alok makes. On different underlyings will have different volatilities, but Alok, also within the same underlying, right? You might have volatilities that change over time, and so just today we were trading the 1240 Reliance Straddle. Yep. And we saw that there was the put premium just went down, even though Reliance was selling off. Yep. And that shows you that even with a move against the straddle, so we're selling the 1240 straddle, but Reliance stock is moving away from 1240, but the 1240 straddle price was going down. In other words, the volatility of the options of Reliance was falling, and that's what we saw today. So volatility is a key factor. Time is a key factor, like Alok mentioned. As you get closer to expiration, the pricing of the options get affected because you have certainty about where the stock is going to expire on expiry day.
I agree. I mean, that is what the most people should view, straddle as. Apparently, we have more than often see that people try to make a judgment based on the, straddles, depending on their chart based call. Well, I mean, charting is good, it gives you a view on underlying and probably you can understand that. But without understanding the component of volatility and at the same time, without understanding how the market is trying to price, what sort of move, probably trading a straddle is not a good idea. And as you move closer to, so, I mean, any options closer to expiry and at the start of an expiry would be a totally different animal, and straddle is not the different from that. So during the when would you buy a straddle? When would you short a straddle? How would you defend a straddle? All those sort of things we're going to watch today. But one thing which I do a lot, and probably I would like to add you from the very start, is that your view on the market. And I'm seeing a lot of good people out there who have a very good charting skills. How you would trade differently straddle using your charts? Probably that would be the key factor, which I do a lot in order to understand my trading, especially around the options, especially around the earnings season, because I try to take an underlying view based on some charts. So we will also share how are we gonna do the taking a view from an underlying from a chart and still trade it straddle, but keeping in mind that it's an option after all, not a trading instrument like a futures.
Okay, great. So that leads us very nicely into the next few slides, where we actually want to give a little bit of introduction on what volatility is. Yeah, sure. I can go and take that. So essentially, with volatility, you are dealing about the speed of the market. Okay, low volatile markets are slow-moving markets, so they don't move too much within the given period of time. Whereas high volatile markets are fast-moving, so they might be moving up or down, in a shorter period of time and have a larger percentage move in that period of time. So you could interpret this, or that is how it's done, is in terms of the standard deviation of the moves. So simply as the standard deviation chart shows you, something that has a very tight distribution and a low standard deviation is a very low volatile market. It doesn't move too much away from the mean price that we have at any given point of time. So options traders or any traders, they look at volatility, and there are different types of or terms that are used for volatility that people use, traders use. And what we'll do is we'll just describe a few, take a few minutes on describing what the different volatilities, when we say historical, when we say realized, when we say implied, what do we mean by that, right? So Vishwesh, you want to talk about what we mean by historical volatility?
I'm sure. I mean, this is one of the very important point one has to understand, that when we say volatility, it merely doesn't mean, implied or historical analysis mean it. But before we go into the volatility, I would like to, take you back to the slide which Prashant has just explained. Now, this slide is a pretty interesting slide, and I'm going to use some of the, marker over here. So if you see, yeah, just give me a minute, please.
Annotate, or whiteboard. You want a whiteboard?
Yeah. So yeah, can everybody see? So first of all, you have to understand one thing. Stock returns are normally distributed and stock prices are log normally distributed. So what it means that if this is your normal distribution curve and this is your mean, then you're talking about a one standard deviation move, which will be something like this. Now your one standard deviation move is basically how much % probability? Can any one of you reply me on a chat? Yeah, so when we say that Straddle is right now, yeah. So Naveen just that's awesome. Yeah. Yeah. So this is 68% of the probability. So one standard deviation of move covers this portion, and this portion is the 68% probability. But one thing you have to understand, that stock returns are distributed. Stock returns are normally distributed because stock returns can be negative, whereas the stock prices are log normally distributed because stock prices cannot be negative, and so is the option prices. And if you know this basic concept, you would probably understand that in order to price an options, the Black and Scholes formula uses a partial differential equation, and a bit of technical over here, but in a partial differential equation, you would understand that when you start understanding this distribution, you have an idea that why your volatility is mean reverting process. Because if you see the mathematical formula of the option, it is nothing but a mu s dt sigma dt, and the only variable is the sigma. Sigma is the volatility, and volatility is a mean reverting process. What does that mean? Volatility cannot keep going up always, and it cannot go down. So what it means, volatility trades in the range, and when you know that this range is there, you can come out with a high degree of probability, or probably you can make your decision based on this, that volatility is trading in the range, and right now the range is over here. So this is a one standard deviation, and the probability of a one standard deviation move is 68%. This is a two standard deviation, and your two standard deviation will cover about 95% of the move. So when we say that currently volatility is exhibiting a two standard deviation move, that means that 95% of the time this volatility was below that. So you understand the basic concept of normal distribution, and when you are trading options for that matter, you should probably know that what sort of moves markets are witnessing. So in a normal standard distribution curve, your volatility is a mean reverting process. At the same time, stock returns are normally distributed, so they can be negative, whereas the stock prices are long normal distribution, it cannot be negative. If you understand this basic concept, then probably you have an idea about when you trade a volatility, it is a good time to short or it is a good time to buy, because since volatility cannot go to zero, and since volatility cannot go to sky, there is always a chance that it will offer you a trading opportunity. And as a trader, and as a instrument, if I just say straddle as an underlying instrument, if you price a straddle, and if you say that right now underlying is witnessing a volatility which is very high, then probably you have an idea whether to buy a straddle or whether to short a straddle. Okay, so now I will move to next slide, and probably what Prashant was talking about is type of volatilities. So I'm sure all of you are aware with the terminologies. So simplest of the simple is simplest of the simple is nothing but your standard deviation. I'm sure, just for the benefit of our participant, I would say that if you're talking about a standard deviation, then you're talking about a movement of any value, or if I had to make it very simpler, let's say every day I'm leaving from my house to office, and I take on an average 30 minutes to reach. So my mean time, my average time to reach office is 30 minutes, right? So okay, is it better now, Vishal, the voice? I guess so. Yeah. Okay. So I was saying that a concept of historical volatility is very much like your average movement. When you leave a house or when you do every process which you every day do, and you know that the average of a last X day is this much, and if you move away from that average, so let's say every day I take a 30 minutes to reach an office. Now next day, if I reach office on a 35th minute, that means I am late by 5 minutes. So now in my office, my colleagues can safely make an argument that Vishwesh has a mean time of reaching office about a 30 minute, and his standard deviation is about a 5 minute. So that means I can either be reached at 25 or at 35 with a certain degree of confidence. So historical standard deviation is nothing but that only. So when you talk about a historical volatility, it is very much the same concept. You take the X period, and the most important argument over here is the X period. The look back period is what we say. When you're talking about a standard deviation, how many days of standard deviation we're talking about? So if you say a 30-day standard deviation, then you're talking about a average price of a 30-day, and from that average price, a movement of underlying. This is nothing but your historic volatility. In a standard term, in a market, we quote HV of about a 252 days, and that is yearly volatility, and because 252 trading sessions are there. So that is nothing but your historical, or for that matter, the underlying realized volatility. For another session, I ask you, Alok, run you to the.
So, before that, this is a beautiful example that Vishwesh gave about. He mentioned a few terms in this this section. Stock returns being log normally distributed, daily returns, stock prices being log normally distributed, and daily returns being normally distributed. And coming back to the example he gave about the time taken to reach office, time taken to reach office can also likely be log normally distributed, right? So he's not going to take negative time to reach office.
Unless
So and then there's going to be some bracket in terms of how much away or less away from the mean he is. So the extra time from that mean is what that standard deviation would be. So yeah, Ashutosh, we're going to try and do that. But there are these very few terms that are very critical to understanding. When we talk about expected moves in the straddle and things like that, we need to know what the standard deviations of the previous daily returns have been.
Okay, I'm just going to add one more quick thought to this. A lot of people will be like, how do you calculate this thing, right? Or where can we get the data to calculate these, and how does it add value to your analysis, right? So the historical volatility is actually published by the NSE on their website every day for every stock, be it cash or be it F&O stocks. It is published on NSE's website. Maybe Naveen, if you have some time, can you just post a link for the historical volatility so that people can go to it, download the file, and play around with how it's calculated. So in that file, you will basically see two numbers. One is basically a daily volatility number, which is generally say about 1.5% for, say, a Nifty or a Bank Nifty index, and maybe slightly higher for individual stocks. Now, how would you convert like this 1.5% daily standard deviation to like an annualized number? There's a very simple formula to do that. You just take square root of 252, which is the number of trading days in a year, and multiply by that 1.2 number or whatever that number is, right? So when you take a square root of, say, 252, that's about 16. So when you multiply 16 by the daily standard deviation, you will get an annualized number. So the reverse process is, if you look at in India VIX, which is still trading around, say, I'm just going to use a very rough number of, say, 16%. Say India VIX was at 16, right? The India VIX is an annualized number. And to convert it into a daily number, you would basically divide that number by a square root of 252, which is roughly divided by 16. So that would give you a daily annualized standard deviation for Nifty of about 1%. I've just taken very round numbers. So at 14, it is about 0.8%, right? 0.885. That's kind of the daily standard deviation of Nifty, or the daily volatility of Nifty.
Yeah, so I mean, see, the one thing which you have to understand is that why we use a jargon. Probably in the first half we want to tell you the jargon, and the second half we want to make it very easier for you to trade them, because ultimately we are traders, we're not bothered about jargon. But one thing you have to understand, that if you Neem Hakim do a Neem Hakim Khatraya Jan, then there is a problem. I have seen more than often people coming to
Vishwesh, can you explain that Neem Hakim? I don't know that.
Yeah, so the Neem Hakim Khatraya Jan is the terminology we use in our side, wherein we say that half knowledge is dangerous. So half knowledge when applied to anything, and this is where we are talking about, making money. I mean, making money is a serious business, right? So serious business has to have a serious approach. And when I say serious approach, it is only mean in terms of you should be aware that why it is follow a normal standard deviation and why you are talking about that, curve. Every time somebody shows you the bell curve, you should know that, oh, the bell curve is that. And when somebody says that, oh, you are trading at a 4 standard deviation move, you should know, boss, there is a 99.9% probability of reverting a mean. Now, there is definitely something which happens, which, you cannot be very sure about that. Even the mean can follow, because mean is nothing but a historical sample size. You're talking about 252 days of observation to calculate that. What if that move goes into the future? So that is the reason why we are showing. Now, while we were talking about historic volatility, which is nothing but a standard deviation, which is standard deviation. And if you simply use an Excel, the best way which I do for my own thing is probably I would have loved to show you that how automatically can be done. But very simplest of the simple thing is that you go to NSE's website, you download any stocks last 30-day or whatever 1 year number, and you go to Excel and you type is equal to standard dev, and it will give you the standard deviation. And then now when you trade this standard deviation, you should know that on a 250-day, this is the normal you can expect a move. Now the same move to expect from implied volatility is we're going to show you in the next slide. Before that, we'll have a look at.
Yeah, I'll go back to the slides now.
Yeah. Okay, so before that, let us move to our next one. So far, are you guys with me on?
So just to one other point to make. Somebody asked about the number of days to calculate. In this particular chart, it's the 30-day standard deviation that is used, and that is annualized over the year. That is plotted on this chart here through 1 year of time.
Yeah, so I think the question was whether you use 252 or 365. So there's calendar years and there's trading days. I personally use trading days because that has more significance. That's also what NSE is, I think, using because NSE doesn't use a 30-day volatility. I think they use a 20-day number to calculate their stock to volatility. And the 20 days basically because there are about 20 days in a trading month.
So one of the indicator which probably a lot of traders use, and me being the prop side trader, I use a lot of this volatility crossovers. So anybody who are into technicals would understand that crossovers are very important. And when a short-term volatility goes above the long-term volatility, there is some trading signal. What and how is probably we can discuss that. But you should have a volatility of various period before arriving at if it is making any sense or not. So far, guys, are you with me on the historical volatility?
Yeah, let's look at. Up to this section, if there are questions, then please go ahead and put them in the chat, so we can look at what you guys may be asking for.
Great.
Okay, yeah, cool. So from here, let's go to the next type of volatility, that a term in terms of volatility that we talk about, and that's the implied volatility.
I mean, Prashant is like a Twitter hero that way, because he's the one who always talk about IV, and probably a lot of people would have renamed him from capital to volatility capital.
A lot of people also run away from my Twitter handle because of all the IV talk that I do. But anyways, that's what interests me. So different things interest different people. But anyway, so implied volatility is what the options market is expecting for the underlying in the next period of time till expiration. So options prices will expect the underlying to move in a certain manner, and it's the expectation of the market of the future realized volatility. So we saw historical volatility. That's the actual move of the underlying in the last n number of days. The example given there was 30 days. You could take 5 days standard deviation and analyze it. You could take 50 days standard deviation and analyze it. Whatever you want to do, you can do. The implied volatility is the expectation of the market and how they price the options of the future realized volatility until expiration. So that's a curve that's the graph of the Bank Nifty at the same period of time, that the historical volatility that we showed you. Just to make note, guys, the difference between historical volatility and implied volatility. Historical volatility is what the stock has done over a look-back period.
And this is where even the pros get confused. I have seen more now.
And implied volatility is what the market is expecting the stock to do in the future, right? And so you probably see this crazy option pricing during the events, right? So like, let's say earnings season's coming up now. Infosys is probably the bellwether that's going to report earnings early October, and you'll suddenly start seeing Infosys options rallying, just options rallying, even without the stock doing anything. And the reason for this is that even though Infosys stock has per se done nothing over the past 20 days and its absolute realized volatility is low, or historical volatility is low, the market is expecting that post the earnings there's going to be a big move on Infosys. So they're starting to bid up options on both sides, right? So the Straddle, which was probably trading right now, say let's assume in October Straddle is trading say $40. The same Straddle the day before earnings is probably going to trade $60, right? Now the reason for this is that market is now expecting Infosys' range post the earnings to be in a larger range, and they're starting to play that by bidding up the options, and that's typically what is priced in the IVs or the implied volatilities.
In fact, I will have to tell you a small story, guys. I mean, if you're up for, I mean, it is pretty interesting.
Yeah, sure.
Okay, so. When the Black's call, Black's call and Merton come out with the, there's a third guy also, Merton. Yeah, and he was pretty.
There's Black shows Merton, and there is another one, right? So the guy who was LTCM, that was Naveen, who was with LTCM?
Okay, so until we get the name, okay. So before 1989. Before 1989, I would like to tell you that there was no terminology as implied volatility. And what option traders were using on a Chicago Board of Mercantile Trade Exchange, that Black's calls throws you volatility, and that volatility is constant throughout the life cycle of the instrument. Now, if you guys would have studied the Black's call model, it has a few assumptions, and out of that few assumptions, one of the assumptions is that volatility is likely to be constant throughout the lifespan of that instrument. Now, the problem with that is markets are not stable. Markets are dynamic, and it keeps changing. So, in the 1989 crash, when markets started falling. 1987 crash, when markets started falling, at that time, market pricing of options was quoting as $20, $30, whereas the model was suggesting $3, $4, $5. And these writers were confused that why market is, giving you that kind of premium, and they were shorting it. But all the guys went wrong because for the first time in life, they were experiencing something called as a fear. And that fear was much higher than the logical same argument. And that is what the market was pricing in. So post 87 crash, ideally, everyone should have thrown the Black's call model into the garbage, right? But they did not have any other means to value the option. So what they came out was, so can you just keep it silent? Yeah. So ideally, they should have thrown the model into the garbage, because that model was unable to pinpoint what was actually happening in the market, and it was flawed. Instead of that, what they did, they reverse engineered. So instead of putting a volatility and getting the number of the price, what they did, they put the market price and they said that now give me the volatility, and this volatility is what actually markets is implying, and that is where the implied volatility terminologies come. So implied volatility terminology is function of the 87 crash, and post that in order to explain what the market. So now there is a volatility which is historical, which everybody knows, and there is something which is quoting by the market, which is called implied, and that is what the implied by the market, and that is how the implied volatility came to the existence.
So I think this also answers Pala, your question about the BS model, right? Yeah, so that's typically how it's done. The Black-Scholes model is basically used to take the current market prices of options and back out what the market is implying about the volatility. Because everything else in a Black-Scholes formula is fairly knowable. So the interest rates can be a kind of discrepancy. People can be using different time frames for pricing different options. So interest rate can be a kind of a subjective variable. But other than that, the strike price, the underlying price, the price of the option, everything is basically fixed. Right, so the only variable in there is IV. So if you take the current market price and put it in the Black-Scholes model, you basically, the term that comes out is basically IV. And yeah, Naveen, John Merriweather wasn't one of the founders of the Black-Scholes model, but both Merton and Scholes were on the principles of LTCM. LTCM was long-term capital management, the firm that blew up in 1998, and that was on the back of a Russian debt crisis. So these guys, these geniuses, and so there's a really great book called When Genius Fails by Roger Lowenstein. When you guys get a chance, read up on that book. It basically details everything about the LTCM collapse. Really good book and very nicely written. So it's not very theoretical, but it actually talks about the live market environment and really what went wrong with LTCM.
Okay, so coming back to these two on this graph here, putting them together, the historical volatility and the implied volatility. What you'll see is that there are periods of time where one is over the other, and that difference is what we're trading. In those sections out there, and that's the generation of the return that we're looking for. We'll go through a few of these charts in different underlyings and see how they all behave in the next few slides there. Yeah? Okay, so let's keep going. All right, so how do we? Okay.
Clean mode.
Yeah, I need to get rid of this. There you go. Okay. Okay, so when we're trading volatility, there are a few questions that you ask yourself in the trade. What is the implied volatility at the time of opening the position, right? What is going to be the future realized volatility from the date to the expiration? We don't know this. This is what the market behavior determines after our trade is complete. Is this future realized volatility going to be less or more than the IV when we open the position? And try to get an estimate of that, we look at what has happened in the past. We always told, past results are not indicative of future returns, but we're looking at the behavior of these factors over the period of time, and looking at trading that behavior in the future. So we're not making predictions of where things are going to go, but we're trading them and making sure our position is protected from losses while we're trading them. So how do we go ahead and do that? Let's look at the next few slides here.
Yeah, you're there.
Okay, there you go. Yeah. So this slide here is simply stating that when we are selling volatility, we obviously want the IV to be larger than the future realized volatility, and vice versa when we are buying it. So what are the
give an example of a trade you did recently on both selling and buying volatility. I think on buying vol, I think DLF pops up, right? This is a trade we actually did last week where we were looking at DLF IVs. Historically, DLF trades in a 40 to 65 kind of range.
Yeah, I mean, on the similar line, if I have to throw the data, if you simply look at last 252 days DLF implied volatility distribution, then you find out that only 14 days out of 242 days, DLF had a volatility below 30. Now that makes it very interesting, right?
So we actually did that trade on the long wall side. The way we structured that was not by buying a straddle, but by doing a call ratio spread, right? So we basically shorted a future and bought 2 at the money calls or just out the money calls. It was a way of playing long wall. Wasn't really a directional play at that time. Delta was neutral, right?
Yeah.
It had almost a 0 delta. The idea was that the volatility should go up no matter which direction the stock goes. And so that's kind of the trades that we do. We don't really do a whole lot of directional bias trades. What we'd like to know is, when we are buying volatility, we want to basically buy things that we think have a higher probability of mean reverting to the upside. And so the slide basically says if IV is less than future realized volatility, we should be selling, and likewise opposite. So in this case, our expectation was that the future realized volatility on DLF would actually be higher than what the implied volatility is suggesting right now, and that's why there was a long wall trade. And short wall, I think that's pretty much every trade that we have on our book, right?
Yeah, I mean today, right? Bank of Baroda.
Bank of Baroda was the customer, right?
So Bank of Baroda opened, as everybody knows, 10% gap down with the news of the Vijay Dinanath Baroda Bank that is floating around, so I think we sold all of that. We sold Strangle.
The volatility jumped from about 50 yesterday to about 80 in the morning. I mean that is probably trading 3 or 4 standard deviations, maybe even for 4, 5, 6 standard deviations. I mean crazy levels, right? You've not seen Bank of Baroda vol trading at 18 since maybe last year this time when recapitalization was announced. At 80 vol, that is the juiciest of juiciest trades for us. The trade we did this morning was to basically sell a 105, 130 strangle, 135, right? 135, 105 strangle. So Strangle is kind of very similar. It's like a brother to Straddle. Straddle basically looks at the money. So if the Bank of Baroda was trading 120, the 120 call and put would be considered a Straddle, while all strikes away from the at the money would be considered like a Strangle combination. So when you're selling a call and a put at the same time, but away from the at the money strike, those are called strangles, and the at the money is called a straddle. So we sold 105, which is about 15, 16 rupees away from where the stock was trading, and about 15, 16 rupees higher as well. So we sold a 135, 105 strangle for about what, 280, 275, 280. And within an hour or so, we covered it at around a buck, right? So we ended up making about a buck in no time.
$1.50, yeah.
Yeah, between a buck and a buck 50 is basically what we made. And this was like a 2-hour trade, right? And so why we did what we did is because we know that, we've seen the historical volatility. We know where the IVs have been. We have a historical IV chart on pretty much every underlying out there. So it's very quick for us to basically gauge when something is trading out of bounds. And then, like Vishwesh said earlier, volatility is one of the most fundamental mean reverting things out there in the world, right? I mean, so if you see a big skew on volatility in a particular direction, taking a contrarian view is just a no-brainer for us.
Yeah.
I mean, first of all, you have to arrive on the same page. That what would you call a low volatility and what would you call a high volatility, and that is where I think it may change from a person.
Yeah, and that's what makes it trade, right? I mean, so as we were selling 80 ball on Bank of Baroda, somebody else was buying it, right? It's going to do 100 or 200 or whatever. So, but that's the difference between how we approach our trading versus others, right? I mean, so a lot of times when when you get these kind of sharp moves on the underlying and the market is caught unawares, you see people scrambling position management, playing absolutely defensive trades, and that's where we like to come in and get a little more aggressive and trade the other side of that view that the people are taking.
So, Alok, would it be fair to say that the beginning of any trading day, you start up and see if there are any big gap downs, gap ups?
Yeah, absolutely. In fact, even before market open, I told you, right? Look at BOB today, right? You got to look for short call plays there.
Okay, yeah.
So yeah, I mean that's the best scanner out there, right? Because we have Shriram Transport was a classic example last month. Yeah, PVR was a great example, right? So there are a lot of these kind of trades where you have a big move on the underlying markets called unawares. So that's where the implied volatility versus the future realized volatility, right? So on a Bank of Baroda, nobody was expecting the stock to fall 15% today, right? So the IVs were not pricing in expected move of 15% in one day, and then suddenly the future realized volatility jumps in, market is for unawares, and boom, you suddenly get an explosion in IV, and that's where we like to come in and basically take that side of the trade.
So the market is expecting, once the move has happened, the market is expecting another big move to happen.
Exactly. That's a very, very rare event. Right?
And that almost the very rare event.
Yeah, I mean, so today, this is another example of how you look at HQs, right? So when you look at the historical movement of Bank of Baroda generally has maybe a volatility of 6%, right, in a day. So when you get a 15% move, that's a 7 standard deviation move, right? A 7 standard deviation move should happen maybe once in 10, 15 years. Right? And if you get one of them today, to expect another one tomorrow is probably the rarest of rare events. It's a very, very, very low probability event that it's going to happen another 50%. So when you're selling an option 15% out of the money on both sides, that to me is a no-brainer that, this trade, even if you hold it to expiry, is going to pay you. But we like to go in, quick out, right? So that's why we basically get out when we have our targets met.
So what was interesting is that when you opened the position, I think it was trading at 122, 123.
Yeah.
And from there, through the day, there was a 5% further move down. Right? I think it closed 16% down.
Yeah, 112, I think it closed.
Yeah, and in spite of that, I think we exited around 117 or 118 when it was there.
Yeah.
In spite of the move from 123 to 118, which is another 5% move down, our option prices were falling,
exactly.
including the puts.
Yeah, and that's exactly right. Because you're selling so much out of the money that the probability of it hitting 105 is extremely low event. So as soon as the panic subsides, everyone's starting to dump those, and the ID basically collapses, right? So initial panic is basically where the balls jump, and that's typically the best time to basically get in and take the other side.
What will be interesting to see? I didn't look at this, but maybe we can look at and see what the 120 straddle was pricing in the morning, and through the day how that varied.
Yeah, I know.
So that'll be interesting. That'll be interesting.
I think a few pointers which I'm able to pick up right now for the benefit of our audience is that you have to arrive at what is a low and what is high, and it varies depending on your own expectations of the move. Probably 1 year is a good observation. Sometimes people use 3 months. Some prop trader even uses 20 days. Some prop trader uses 6 months. Second, you should probably be consensus. You should be on the view that normally or more than often, IVs are higher than the RVs. So implied volatility, which market pricing is higher. And there's a fundamental reason behind that. More or less, people are afraid about the larger moves and they want to hedge themselves. And that is why you see that implied volatility on most of the instruments are higher than the realized volatility. But this all things needs to be tested. And the very slide which you're seeing right now on the screen is the relationship of a volatility and the historical volatility and volatility. So, I mean, if I had to tell you from an indicator perspective that what all the indicators you should probably look at. So, historical volatility to implied volatility ratio. This is probably a few things which ourselves looks of. On top of that, if you have somehow a data of an implied volatility, then probably you can look at the implied volatility relationship to itself, which will be an implied volatility rank, and in terms of a percentile, that in a normal distribution curve where the volatility is tending compared to the X period. And if I had to quote you this from a perspective of so this is the formula. This is the formula to calculate the implied volatility rank. So basically, implied volatility rank is a best way in our opinion right now, and not only way, but it is one of the very good way for you to judge where the current volatility, or for that matter, current implied volatility is trading with regard to its historical highest and lowest volatility. So this is simplest statistical way of calculating the implied volatility. Over here, what you're trying to understand. Over here, you're simply trying to understand that implied volatility with regard to its. So, if this is a timeline of 252 days, then this is a bar. These are all the bars, and if I just make this is probably some number. Yeah, so I'm just making a one drawing. This is a 15. A 15 in the last 1 year is a historical volatility. And if you plot a bar of implied volatility, then probably you know that current volatility in conjunction with the historical volatility is trading highest, and that is what probably the market is trying to do. So I mean, if I just make it more simpler, yeah. If I just make it more simpler, then in the previous slide. Wait, let me just go to previous slide. Yeah, this is a chart of implied volatility. Now here, what I was trying to quote you, on the right side, you have the x of the y-axis of the volatility, and this white line is basically your implied volatility. And if you see that white line implied volatility in the period of last 1 year has the highest high of about 26% and lowest low of about 11% odd. Right, this is a bank nifty implied volatility, and in here, if you understand that if you compare the current volatility, this chart was back in I think mid of July, I believe. So around 13% is nowhere in the any range where we would call it a high or low. It is just there in the middle, or probably a slight fall in the volatility would call you a low volatility environment. So the best way for you, I mean, a lot of chartists are there in our audience right now today. If you can do a lot of charting techniques around the volatility, keeping in mind that volatility is a mean reverting process, then probably you have an edge in terms of trading the volatility. So just now, we have given you an example of a DLF, and why the DLF implied volatility around 38 is the lowest of the last 1.5 to 2 years is because it is trading at the lower end of the range, and it being a mean reverting process, there is a chances of it reverting to mean. So what is the mean of the last 1.5 year, or what is the highest volatility of the last 1.5 year? And around this 1.5 year volatility, if the volatility is tend to trade about 48%, then buying at 38, you have a lower chances of losing money on a long volatility trade. That is a correct interpretation in my view of a trading volatility. So in order to judge a volatility, you have to understand few things. One is the volatility rank. Volatility rank is calculated by current volatility minus the lowest volatility divided by the max volatility minus the mean volatility. And there are few open source and free resources available out there where the IV ranks are freely available. Okay, there is a okay. I'm very happy to hear from Umashankar super explanation. If IVR is higher than the 50%, then the current IV is on the higher side. Well, Umashankar, I would like to tell you that when you say that IVs are higher or lower, it is always in conjunction with the historical movement of that time series. That means implied volatility comparison of its own will tell you whether it is higher or lower. So the way we trade, we would like to trade, percentile. So if you are trading in the lowest percentile range of a 5%, 10% range of the lower side, then you want to buy. And if you are trading somewhere around higher side, let's say 75-80% of the higher range, then probably you have to start considering about a shorting. I'm not implying that it is an absolute thumb rule, but this works most of the time. And in the earnings season, what we have found out that higher volatility ranges is a very good opportunity to short. So this is one of the indicators which we use, which is implied volatility rank. The second is the implied volatility percentile. And implied volatility percentile is not in terms of the comparison with its own value, but comparison of its value, that how many days in the past this volatility was trading above, lower or upper. So you say that the current volatility is 15%. I say that IVP of let's say 5%. So there was only 5% of the days when the implied volatility was trading below this level. Right, so that is the interpretation of the implied volatility percentile. And while this is a good indicator, but if we have to choose, then merely days is not a very good day idea. The way we use it, we use implied volatility rank over the implied volatility percent. Prashant is the master of that, and probably would like to add something more here.
No, there are implied volatility percentile is a good number to look at the regime that the volatility might be in. Because there might be events that are single day events. So for example, a Bank of Baroda, an event like today would be a single event, which now because of that high IV today will affect the IV rank calculations going forward. So some people who are looking at an IV rank, 3 months down the road, will find that the IV rank on Bank of Baroda will be low for a period of time. Although the volatilities might still be higher compared to what has happened in Bank of Baroda in the past. Because of today's move, the IV rank will show lower. And so, and that's why a lot of traders use implied volatility percentile, because that one day of today, and whatever, there might be a few days where the volatility will linger and slowly dissipate downwards. The IVP is an estimate of that regime, of that period of time 6 months later.
So it is a one good way of removing the outlier. A lot of people. So if you were trading the last year where there was a recapitalization, then probably that spike in the bank was an outlier. There was no way for someone to predict that unless you are that pessimist that everything's going to blow up and you just buy a Straddle or Straddle and it turned out to be a money making proposition. But it is a good way to remove the outliers. A lot of people use it for the short-term phenomena wherein they remove the spike.
Yeah. So if you can use IVP, but just because IVP is a high number, I would not go ahead and short or sell volatility. I want to actually look at the actual number of IV that we are trading and see how that number has been in relation to its past. So I might look at the 1 year, and then I might look at the 6 months, just because there might be an event that was 9 months ago that was very high. So I look at the 6 month range and see how that plays out.
That typically happened with us. What happened was, as we were doing historical IV numbers, I was using a 1 year IVR, and a lot of the bank IVs during recapitalization are actually shot up very, very large, right? So even ICICI Bank, SBI, all of these had very, very high IVs in October last year. And so when you use a 1 year IVR and you're comparing today's vol versus a 1 year range, the IVR on all of these bank stocks was really low. But if you look at the same numbers on a 6 month, removing that recapitalization event, the IVR was not as low. And that basically is what Prashant was saying, is that when you look at it over different time frames, some of these outliers that have happened over a period of time are not likely to happen again and again, right? The recapitalization is not going to happen every time. So removing some of these outliers is actually a good way of kind of normalizing your IV rank. So account for a normalized market condition.
Again, somebody may say that in the jargon, but there is something called the Windsor mean. If you just Google that, you will get an idea. Windsor mean is a good way for you to arrange the distribution of the time series, and that would remove the outlier, considering that it would try to stay in the confidence interval which you provide. So probably if you say that 98% of the confidence, then those 2% will automatically, which I use a lot for my own trading. But moving to a next slide. So far, are you guys with me? I mean, there are a couple of questions we would answer before moving. Meanwhile, you guys can reply with your understanding of. So
yeah, before we go into the
Naveen is asking if high vol probability of move for one standard deviation is higher. So is Strangle safe? Hello?
If high vol probability of move for one standard deviation is higher, so is Strangle safe? Yeah, Strangle is definitely more safer than say a Straddle, right? And so there is no safety in trading right? I mean, there is no safe trade. If there was a safe trade, which is risky, then there would be no premium in the market. Yeah, but relatively, Strangle would be, I feel more comfortable. Like so today, when Bank of Baroda's vol exploded, we had the option of selling a 120 Straddle. It just, for us, when I trade, I like to have some form of a margin, call it a cushion or whatever you want to call it, in case if I'm wrong on the underlying view, right? So even though a 15% move on Bank of Baroda is an unlikely event, the fact that it can happen again is still a probability, right? It's a small probability, but it's still a probability. So when you sell something another 15-20% out of the money, the trade does feel safe. Now that's not to say that I would have guaranteed to make money on the trade. If we had another 50% move down on Bank of Baroda tomorrow, my trade would have hurt. Right, so that's why these are more often than not quick in, quick out kind of trades. You make your, we've got some standard rules that we apply when we enter a trade, and once the profit targets are hit, we basically exit.
That's a good one, Alok. I think there's one more question by Bala asking, whenever you have a few seconds, can you please explain the difference between HV and future realized volatility? I think, Prashant, we had a very good debate around this future realized volatility and the, HV and IV on the Twitter. I think you were the one who were taking lead on, you and probably me on the same page about the same. Would you like to?
Yeah. So HV is the standard deviation of the moves in the past, and the future realized volatility is, in a way, what you would calculate the HV to be at a point of time in the future. So a 30-day future realized volatility would be from today, the next 30 days, what was the standard deviations of the moves in the stock as we go from today till 30 days. So 30 days later, the HV that you calculate is today's future realized volatility. So if you're, and that is what the market is pricing in. Market is pricing in, it might be 30 days, it might be 15 days, it might be whatever number of days. Days to expiration. So the IV is pricing in a certain expected move from today till the days of expiration. And when we do reach the day of expiration, what was the HV of the past? And that's what the future realized volatility is for today.
Hope that answers your question, Bala. Yash is asking, I think, Prashant, IV percentile length for that matter, IV rank is calculated for 1 year. Yeah, I think, see, this is where I would like to give you a very good example. As you guys know that I'm a prop trader, and a lot of the prop trader, my buddies on the different desks, use varieties of technique, and probably you'll be surprised because if you are trading on a very short-term mechanism, a short-term time frame, and that too also you're trading only around the Vega, and you're not bothered about the Delta, then you will trade a 5 days volatility range. So I'll give you a very simplest example. Maruti, if you have a, for the matter, implied volatility intraday data of a Maruti, this is a very good example. You just go and look at out of last 1 year, distribution of implied volatility of Maruti during the intraday, there was 70% of the time Maruti's IV range was 18 and 22. Prashant. And my buddies over the prop desk, if volatility of Maruti comes to 22, they blindly sell. 3.6 comes, they will just blindly buy, and they will keep doing it. But they have no clue ready that the volatility rank and all those things are low. And I keep telling boss, the IVRs are pretty low and it can really explode. They say that we don't care, and suddenly Maruti started doing that. So time frame of a trader, so more than often in technical, we say that trend is a function of a time. So over here also, if you are a very short-term volatility trader, and if you are trading a 2 points on IV, then probably you're not bothered about such a large look back period. And when you keep a huge Vega, so simplest way to understand the Vega is that if you have a Vega of 5,000, a 1% vol drop will make you 5,000 rupees. Right. So when these guys play a 2% or 2 tick down move in the IV, they have a Vega of 10,000, 15,000, and all they make is about 30,000, 40,000 in a matter of 2-3 days. And I just keep wondering that how. So what they say is that all we look at is the Maruti, and we don't do anything else. Right, and they see each price implied volatility, and they have the number. And these guys are not, sophisticated, highly college graduate. They are pretty much, a commerce graduate, and all they see is the price. So you don't need to be very fancy with the maths over here. All you need is the understanding of how the market is pricing. And so the idea over here is why I'm saying that look back period is the single most important thing if you are a vol trader. So I think we've tried answering the question, and I think now we'll run to the next slide, which is the time series of a Nifty, HV versus IV. And I think it's Prashant's favorite, so I will give him a,
No, actually, so this slide was made, I want to give the credit where it's due. It's made by Alok, and Alok has some very nifty tools for the Nifty, where he's got this database of all underlyings in our FNO universe, and he gets these IV HV calculations done for the time series that we have. And so Alok, you just talk if you want to talk about this slide, how we use it.
So I think before I would like to just give the credit to Alok is an ex-trader from Merrill Lynch University, and he has traded a huge this commodity spread, and for him everything is around the spread. So unless and until he gets comfortable with the data, he doesn't even ready to speak with us. Whatever we say, then I just want to have a look at the data. So the biggest problem we were facing is relying on someone else's data. So he took up a very great task, and he created his own database. He wrote us some cool Python stuff, and this is what the output looks like. So now whenever we need a data, we just ask Alok.
Yeah, a lot of this is basically automated now. It's a click of a button every day. So you guys know NSE publishes a how copy, which is the end of day prices of so open, high, low, close, volume, open interest for every option and every future out there that was traded on the day. And so they basically at the end of the day will publish that file. Each day's file is about 30,000 rows, I think, of data. So my system basically grabs that, puts it in the database, and then I have a script that basically runs through that data and generates these charts on the fly, right? And so I can generate this right away for today's data if today's EOE Bob is already in. It's a very simple calculation. A lot of the guys already asked how you calculate IVs and stuff. It's a very simple Black-Scholes formula. All I do is I take the price of the option, price of the underlying, and then calculate what the IVs are. The HVs, like I said, are already published by NSE. So the IV to HV ratio is just the ratio of the two. So the bottom line you see on the chart is the yellow line is basically the ratio of the IV to HV, and the top lines actually have the individual components, the IVs and the HVs. The way we like to trade this is, going back to one of the slides we had earlier, when IVs are greater than HVs, we want to be basically all sellers. And when IVs are less than HVs, we want to be all buyers. So on this chart, when the white line is over the orange line, you want to be basically selling, and when the white is under the orange, you want to basically be buying. Or when the yellow line is over 1, you want to basically sell, and when the yellow line is under 1, you want to basically buy. So that's in very simplistic terms, that's what that chart is telling you.
And so far, guys, I would like to tell you once again that though the webinar is planned around the Straddle, we have tried very hard to make it so generic that you can apply to almost all trading strategies, because we are telling you the fundamental concept of what the walls are, how high the walls can be, how low the walls can be. Now, what strategy you pick it up? It's a long subject, and probably some other day we'll pick up a session to talk about that. But right now, we are just trying to tell you that if the walls are low, then buying a straddle or buying a strangle, or for that matter, buying an option is a good idea. If the walls are high, then opposite could be true. Yeah. So we'll move to the next slide now.
So coming back to what Vishesh just said, in very simplistic terms, buying volatility is equal to buying options, and selling volatility is equal to selling options, right? So now if you have a spread on, if you're selling a straddle, that means you're selling a call and selling a put. So you sold 2 options, and essentially you have a short wall play here. And then buying a straddle or a strangle implies buying a call, buying a put. And obviously when you're buying options, you're basically long wall by definition.
So you're trading these areas there, right?
Yeah. I don't know if you can see that.
I don't know if you guys can see the coloring that I'm doing here, sitting on the side.
But the other thing, the easier way to look at it is the ratio, right? About 1 is really your time when you want to basically sell wall, and under 1 is really when you want to basically buy wall, right? So
all those times you want to sell wall.
Yeah.
You guys see the little bit of coloring? Yeah. Okay. Okay. So yeah. So let's look at going forward. Let's look at how different underlyings behave. So what you can see in this Nifty chart is that you have a lot of the times the IV is higher than the HV, and that gives us what the edge is in options trading, being that the expected move of the underlying is lower than what, or the expected move of that the market is higher than what the actual move that happens over the time to expiration. So let's look at what this chart looks like for a few different underlyings that we have in our FNO universe. That's one for Nifty. For the Bank Nifty, here we go.
The mouse. First one.
Mouse. Oh wait. Okay.
Yeah. Now you move.
Thanks, Suresh.
That's right.
There we go. Yeah. All right. Bank Nifty. This is, I think, the most favorite underlying. It's like all-time favorite for every trader out there, right?
Most people on the Twitter are around them only.
Around Bank Nifty.
Because the daily option. I'm telling you, if they start a daily option, whatever they start the daily option on is gonna be the new hot Favorite. And so in all fairness, I actually traded daily options on crude oil, about 10 years ago. So there are actually options that are traded on a daily basis, right? So they have a 1-day expiry. It's like every day is an expiry, right? And a lot of these options were not traded on the exchange, but they were traded by individual brokers on what's called the OTC market, the over-the-counter market. So brokers, if I want to trade a daily expiry on crude oil today, if I had a view, I just call up a broker and say, make me a market. You make your market, you basically go long or short, right? And then at the end of the day, whatever premium you collected or deployed is basically settled at the end of the day based on what the closing price is. So daily options are a thing. There are other different types of options called binary options, which are either a 0 or 1 kind of option. So those are, Vishwesh has created them as well. Binary options are interesting because, all it is a crossover over a certain price. So let's assume that, say, I'm trading Nifty and I'm trading a binary option on Nifty with a closing strike price of, say, 11,500. If today's close was over 11,500, I would make 1 rupee. If it doesn't, then I make 0, right? So it's a 0 or 1 payoff. So those are kind of binary options.
And the interesting part in the international.
So in a lot of cases, the Bank Nifty weeklies become binary options at 3 p.m. on Thursday, right?
That's exactly what it is, right? It's a 1 option, right? And this is where like people, belong to believe, right? Who has a view on what the price is going to be, and he goes and buy the options, and it's a 0 or 0 kind of problem.
Yeah.
But eventually, first thing you have to understand that when you trade such instrument, for that matter, on last half an hour, you try to buy a option in order to make yourself, buying a lottery ticket kind of thing. You should know that what odds are you playing. That is the single most important thing we would like to tell you. If you have a system around it, cool. Otherwise, just tossing the coin is something we wouldn't advise.
Yeah.
So there's a pretty interesting chart, Prashant, out there on the screen.
So I want to ask the audience, get a little bit of interaction from the audience on this one. You guys saw the Nifty chart, and now you're seeing the Bank Nifty chart. I'm going to put both of them. Let's see, how will I exit this? I'm going to put both of them on there and just get some discussion going. And let's see if. Okay, screen sharing has stopped. Okay, hold on. I'll just put both of them on one slide.
They're all pictures, so you just cut and paste them and put them on screen. You want these charts? I have them separately on a folder, so you just want to pull up both of them and kind of put them on screen.
Okay, fine. So let me just doesn't matter. We'll put them up one by one. No issues. Okay, so that was the Nifty, and that's the Bank Nifty. Just an open question to everybody. What is the first thing that you guys notice looking at the volatility orange and white line compared to the Nifty? Can you guys just comment and in the chat window what you guys notice on there? Anybody? Any observations from that? Okay, Naveen says very low IB environment. Okay, what else? You guys notice that there are long periods of time where this orange line is above the white line. The orange line is the historical volatility, and the white line is the IV. And those that have read some of my tweets will know that I get into a lot of trouble with a lot of people when I question people trying to sell Bank Nifty volatility. And the simple reason is this chart out here. This chart tells you that look at this time here, you look at all this time here, you look at all this time here, you look at all of 2018. The IV is much lower than the HV in all of these cases. And that's very well exemplified in the lower chart as well, right? Look at, that's your line of 1. And how much of the time is spent lower than 1? So IV by HV ratio is less than 1. And there are very few periods of time when that is higher. And almost everybody that you talk to on Twitter is selling Bank Nifty options, right? Yeah. So I don't know what they're thinking when they're selling Bank Nifty options, and then they'll end up blowing up their account, or they'll end up paying tons of brokerage, managing their trades left, right, and just go crazy, tear the head out. So an understanding of when to sell Bank Nifty. I'm not saying Bank Nifty options are not to be sold, but when to sell Bank Nifty options, how to sell them, what are the correct hedges to take, and that's very critical. A lot of this data is with monthly options, I believe.
Yeah. No. These are weekly options.
These are daily prices.
Actually, you know what? On buy Nifty, they are monthly options.
On weekly options.
No, monthly.
Monthly options, yeah. So monthly options are a beautiful. This shows you that monthly options are a beautiful way to hedge selling weekly options. And that's one of the trades that we do a lot.
You know what's actually interesting, now that you bring that topic up, I think a lot of the reason why you see this discrepancy is also because monthly options, since the weeklies have started, have actually lost a lot of volume in open interest. Right? Like it only really gains interest as soon as it becomes a weekly.
Okay.
Right. So I think that could be the reason why this period of, because this is exactly the time frame when weekly options were introduced.
Yeah.
June 16 was when they introduced weekly options. And the entire period is because the weeklies have picked up a lot of the volatility and the IVs, right? So maybe these are, correct me if I'm wrong, but maybe there's no volume or open interest or interest.
No, I don't think that's correct, because there was another study which data you pulled out where the volume of trades has actually increased across the board since the weeklies were, including the monthlies.
Yes,
the monthly volumes have increased.
So right now, if you look at a monthly,
but the open interest is something different.
Yeah. So there is not a whole lot of trading going on in the monthlies, right? Right now all the focus is on the weeklies. As soon as tomorrow expires, that's when the monthlies are going to start picking up volume and open interest. So in the last week of expiry is where the monthly options of Nifty are actually picking up speed in terms of the volume, the open interest and everything. So maybe that's why I don't know that the look-back period is actually very interesting because that's exactly the time when Nifty weeklies were introduced.
Okay.
So it could be, I don't know. Good question on what it was that we were looking at, and the idea is the monthly.
But apparently, the simplest way for me to put it is that the heaviest, component of the bank Nifty is HDFC, and the similar nature you will see in HDFC.
That's the point.
HDFC's implied volatility is higher than the implied volatility.
This one is a classic example. Look, how many times is it spent under the one line, right?
I remember this particularly. Because I trade heavily this instruments, right? And you cannot short sell this guy. They blew you off in the face of it.
It's all over the place. There are.
And even the HDFC.
There are periods of time where there are spikes.
Just the expiry related, right? They could be just expiry spikes. Right?
Sure.
The majority of the time has been spent under, right? So the orange is over the white predominantly, right? Which is what you're seeing on the IBHD thing as well. Except for the expiry related spikes, right? I think this is expiry, this is probably expiry as well. So I think the expiry related spikes are what's causing that skew to the.
Yeah, so I think Kushal is making a good point that it is during a bull market. But Kushal, along with a bull market, I would like to tell you that these are the highly owned stocks. So what happens? I am the fund manager. I have already 1,000 crore or 500 crore of total AUM. Out of that 100 crore is probably I have HDFC Bank, and I don't know if tomorrow Deepak Parekh dies. So all I want to do is I want to hedge myself, right? So all I do is I buy an option, and in order to buy an option, I bid high, and that is why you see that realized moves are relatively higher.
Okay, so let's look at Implied. This is one of the favorite ones, right?
Those spikes are actually real. Those are not expected spikes. Those are earning spikes.
We all must have traded them.
Those are earning spikes. Those are real earning spikes.
Yeah, this one is a favorite. I don't know when this trade is going to die out, but I hope never. At some point, it will die out.
I have been trading this for the past 7 years, I believe, and I have had almost 80% success ratio on these.
And I think Alok is a wonderful study around that, probably.
Yeah, I think there are probably some slides on that later if you have time to show you.
So in this chart, you have the white spikes in implied volatility, which are the earnings events for Infosys. And as soon as the earnings comes out, you see almost the same day or within a couple of days, the IV falls back down and crashes down. And this is a beautiful way that we trade. We trade both the way up as well as the way down on Implied. Okay, so HDFC Bank, DLF, right? This is the one of the examples where IV is not overstated, and you have regimes of low volatility, and you have the moves in the underlying being much more than what the market is implying. So a lot of times this is a good candidate for buying IV in the market or buying options in the market.
I've done maybe 3 or 4 long haul trades in the last 3 months, and 2 of them have been on DLF. So one of them on Implied and 2 of them on DLF.
So there are 2 ways.
Here is a classic example. If you look at this chart, You're right? Yeah, just draw horizontal line at the 40, right?
Yeah, that's
look,
what I'm
look
doing.
at that. Yeah, so that is a.
This is the all period we were talking some time back, and we also did and that is the reason why we want to be a long vol.
And this is the one trade that we did very successfully. This one right here, this is July, right? Yeah. So this was one of our long vol trades here, and we got that big jump in IV, right? This we actually captured. This one we did capture a little bit on that move up.
I think it's not there in the chart now.
Yeah, it's not there. There is probably a move up, much bigger move that we actually picked up as well. So,
but guys, what are we trying to say? The point here is that you all are wonderful chartists, right? You understand charts. It's the simplest of the simplest technique we are talking. You have a underlying instrument, or for that matter, time series. In this case, it is implied volatility. You have a range. Now, even my son, he's just 3.5, 4 years. He would say that, Daddy, whenever it comes to 40, just buy them. It goes back to 60. That's it. That's the simplest trade you have.
And because look, that's not to say that every time 40 is gonna go to 60. It's just that the thing that we plotted up there is one of the most fundamental mean reverting things.
Exactly.
Right? So anything that comes down to 40 and bounces back to 60, on price, I don't know, but on volatility, I have a very high probability that it's going to bounce back up to 60.
But here, when you buy a volatility, I would like to tell you that it is not that simple. Because when you buy a volatility, you pay price to the market, and when you pay the price to the market, your options are going to get leakage, and that is where the thing comes.
Yeah, Straddle, buy the Straddle.
Yeah, you can buy Straddle, you can buy Straddle, you can. But the
important thing is the IV low enough. Yeah, I mean the thing is if your IVs are high, then you don't want to be basically buying long vol, right? And this is an answer to Yash. You're asking if you want to discuss long vol strategies. There is really no long vol or short vol, right? The underlying is a Straddle. If you want to go long vol, you buy the Straddle. If you want to go short vol, you short the Straddle. So that's the Straddle, right?
And
as simple as that.
When
you do it and on what you do it is really the key.
In fact, if you are aware of one more structure which is called strip and strap. Now, strip and strap is where your skills of underlying comes in. You know that the volatilities are low, but you have a tilted bias towards something. Why don't you just convert a ratio? So in a strip, what you do is you buy a more call versus the put, and in the strap, what you do is you buy a 2 put and a 1 call. Now that is the simplest way to put it. The fundamental is your theta is going to be hurting you, and you have to scalp it somehow. And probably some session will show. One of the favorite subject of Twitter, and that's where all the war has started. Gamma scalping.
So Nidhi asked a very good question. On Bank Nifty options, is buying a monthly straddle or triangle and selling the weekly works better. So that's actually a very good trade that a lot of people do. We don't want to recommend any particular trades, but that's a good trade where you're selling. It's a good structure, and it's what you'd call a double calendar, where you're selling a put calendar, you're doing a put calendar below the market and a call calendar above the market. So yeah, that's something that you can look at.
Okay, next slide.
Okay, so let's quickly go through the slides. We are running into and Dhamchand Setia, who's our other expert, who's going to join us shortly, is going to come up at 7 o'clock. He's going to talk a lot about open interest,
how you
read open interest and use that in trading. So yeah, I think these charts, a lot of them are bringing home the same point about comparing volatility and trading the spread between the HV and IV, and that's what we mean by volatility trading. So let's quickly get to some of the trade structures that we have. Yeah.
And so far we haven't even talked about the underlying price chart at all, and that is what we feel, that after all, options are different instruments than the underlying, and merely looking at a price chart will not give you an edge instead of looking to a volatility.
Yeah, but it's interesting you brought the underlying price chart in, because that ties in nicely with how you would use the underlying price chart in conjunction with the volatility view. So all this discussion up to now, almost half our talk was about how to get to a volatility view and where the volatility is in relation to its past. So you can marry that with a traditional price chart of the underlying and take a view on where the underlying might move to. There was a recent interview of Nathan Berg on Tracy Trade, and he talked about trading volatility, and he talked about trading volatility, how they do it. They are market maker. His firm is a market maker in the US options, and they are essentially trading the bid-ask spread, and that's all they're doing. And so with their huge volume, they're able to take completely delta neutral, gamma neutral position and just trade the Vega effect. And one of the hosts asked him, for a retail person who's trading, is that a feasible approach? And his view was that somebody who's retail might not have the size and also the execution ability to keep your position delta neutral at all times. And so from that perspective, it might make sense for that person to trade a directional view along with the volatility view. Exactly. What we'll do is we'll try and find that and put that put a link of that interview online.
The start is really nice. If people have understood what we have said so far, let's see if you guys can tell us where a straddle would fit in. Which of these buckets would a straddle fit in?
So to repeat the question, Alok, there are 9 buckets here. Bullish view of the underlying, low IV. So horizontally you're going up in IV, and vertically you're going in bullish, neutral, and bearish.
So I would simplify it. I think a layman language. 2 things you need, absolute 2 things only you need to make a very successful money in the options. One is the view on volatility, and second is the view on underlying. Given 2, this matrix forms. Right. So our question is that so far what we've discussed, where would you put a straddle in the this 3x3 matrix?
Come on, guys.
Let's get some participation here.
Throw something out so that we can follow it up.
Okay, Uma Shankar nails it. Neutral with high volatility, so you sell a straddle.
That's right.
Neutral, underlying high volatility, sell. Okay, beautiful answers.
Wonderful, guys.
Okay, so exactly. So, that's the link, Naveen, of the Native interview. Thanks, Naveen.
Thank you.
So yeah, you want to sell high IV, and neutral view for the underlying is when you want the straddle. But if you can take a directional view on the underlying, you can sell straddles that are away from the underlying as well.
That's a super trade you do all the time in the earnings.
And Naveen, who's in the other room back there, supporting this chat here, did a beautiful trade on Bank Nifty today, where he was selling the 26,500 straddle almost an hour into the open. He was selling the 26,500 straddle, and that's a bearish view on the underlying, and he's selling the straddle away from the market. Okay, he was selling the 26,500 straddle, and he was buying for protection the 26,400 and 26,600 strangle. And the risk in that trade, we're going to talk about those trades. They're also called iron flies. And Naveen set up that iron fly beautifully. It's a 100-point width iron fly, where 100 points is the maximum risk on the trade, and he collected 96 rupees of premium. So his risk in that trade was only 4 rupees. To make that's 24:1 risk to reward trade. That's a beautiful trade. And who knows, tomorrow you might get expiry and that iron fly goes to 0. So per lot capturing 96 points is just fantastic. Today, what was the trading at, Naveen? At the end,
it was trading at about 76.
Yeah.
So I'm already making money on the trade. So 20 bucks on the trade, and as Prashant has been telling that if you get 50, 40, anything near that level, I book out. It's a good trade. I thought the market was weak in the morning, and I was getting a good value on the.
Come in closer, Naveen. Then
I was getting a good value on that identified trade, and I just put it on. It was 96. I thought 4 rupees is my risk. So why not put it on and let's see how that works. And it was completely based on my view that the Bank Nifty looked weak right from the day go. So yeah, that was it.
Just another quick note on that, guys. Don't always think that a 4 rupee option can go to 100. 24:1 odds are not given just for nothing. The probability of this trade working out in this favor was only about 4%, which is what the premium paid was. So it was a low probability event, but combined with the view on the underlying, some of these trades can become very, very highly rewarding. So just something to be mindful of.
So I think during the earnings season we trade straddle pretty differently, and that's something which you could do. Is that if the underlying view looks bullish but the volatility is higher and you expect it to go higher, you can start a couple of strikes away straddle, and it will give you credit. Since the vol higher, it will give you credit, give you big range, and since the vol will fall and the underlying will move higher, that short straddle trade will move in your favor.
So This is why don't you talk about it, Alok? So there's a beautiful Bank Nifty straddle short strategy that Alok put together based on a lot of discussion we had.
So June 2016, like I said, Bank Nifty weekly options started. So I have end of day data for all these weekly options. All I did was, we were having this discussion just like this. The few of us sitting together, and Vishwesh is basically talking about somebody he knows who's basically in the business of just coming in every morning, selling the Bank Nifty weekly straddle at the money, whatever the market's opened at, and at the end of the day, he covers his position. And he said this guy is consistently making X amount of money. And like I said, one of the things Vishwesh said earlier on is that when somebody tells me that XYZ is making XYZ amount of money on a particular strategy, I like to test it, right? I mean, so I basically took all the data that I had and I tested this hypothesis, and I actually simulated a trade wherein since 2016, every morning I'd come in and say Bank Nifty tomorrow opens gap down to 26,000. First tick open trade 26,000, call and put you sell and cover it at the end of the day, right? And then day after tomorrow you come in and say Bank Nifty is 26,500. You sell the 26,500 straddle, call and put, and cover it at the end of the day. So I ran this for about 531 trading days, what I have, I think here, right? So this is the backtested results. So the total of about 531 days, cumulative PNL of about 1,700 points should have been collected. Total number of positive days was 368. About 70% of the time your trade works out, 30% of the time it doesn't. You collected a gross 11,500 points and lost 9,800 points. Your average positive PNL was 31 points and your loss on the loss-making days was about 60 points. Look at the max drawdown. I think that's probably the recapitalization day. Yeah, the recapitalization day was a big drawdown.
But this is without any sort of management.
No management at all. No, just buy at the open, sell at the open, buy at the close, right? And so that's what the result looks like. That's what the equity curve looks like. So you see that sharp drawdown. No, that was the February thing. I think there was another one big drawdown. I think I think that's the one. That's the one where you had a big drawdown. This was recapitalization day. Yeah, October 24th, I remember. And so the other thing we did was we had another guy that I pitched this strategy to somebody. He had his own interesting way of looking at the market. He's been exclusively trading Bank Nifty options for the past couple of years, and he has this theory that Tuesdays and Wednesdays are horrible for selling Bank Nifty options. So this is another hypothesis that we like to test out, and it is very interesting that not so much Tuesday, but Wednesday is definitely a day you don't want to do this strategy. If you look at the distribution of your 1,700 points that you collected, the bulk of them are basically on a Thursday, which is obviously settlement day. And then, the remaining 3 days, Friday, Monday, and Tuesday has a pretty decent distribution. It's just the Wednesday, which is kind of a break-even day, right? You don't make anything. So if you avoid doing these Bank Nifty straddle trades every morning and covering it at the end of the day on a Wednesday, except for the Wednesday, you end up making money almost every day of the week.
Now, once again, we're not suggesting any particular strategy to you guys. This is not a recommendation for you to trade this.
Yeah, he's just putting a data.
And like I said, guys, when you're doing a back testing and selling on open and buying on close, it looks really great on paper.
Yeah.
Living through the intraday volatility is probably going to be like a few bottles of peptide or what antacid things that we had. It's crazy volatility. Living through it is not everyone's cup of tea. So please do your own research and stuff. This is not a strategy that we are deploying in our book. It is just something I want to show since we're talking about strategies.
Yeah. So what we're going to do is we're going to try and finish up our part of the webinar with this last one slide on straddles. So far that we talked about selling. I'll take a few questions at that time. Last 20 minutes, and then Dharam is already here in the webinar, and he can take over from there. So with straddles, what we'll do is we'll each of us go through and talk about some straddles that we like to sell in a systematic manner. So maybe Vishwesh can start. What kind of straddles do you sell? When do you get into them? When do you exit? We'll put some basic rules on profit targets. But what do you do in your trading?
So the way I have in fact, this is not a good forum to quote the data, but then I haven't been a very successful short straddle trader. That is my experience. On the other hand, I have often got money buying a straddle. Oh, okay. So the simplest way which I have built is compare a volatility to 30 days and 60 days. And if a 30-day to 60-day, if volatility is trading at a lower 5 percentile quartile, right? You want to buy straddle, and as it starts moving in your favor, as the vol start increasing, you have to short the other side to get credit and reduce your straddle pricing. So this is the one thing which we are not discussing right now, but I'm just saying that simply trading straddle or simply buying straddle, and okay, when you buy a straddle, you have to give yourself a lot of time also. So the way I do is, okay, so there is one more data which probably I can. So historically, if Bank Nifty 45th, 45 day to expiry theta is probably the highest. So if you 45 days to expiry at the money short straddle is done, then in the next 20 days, it has a 60% chances of losing its value by about a 40 to 60%. So what the data means is that if you give yourself a time, then at the money straddle, 45 days to expiry will give you enough credit, 300 odd. So it gives you a good range on the both sides. And more than likely, if the market remains in the range, then you, Prashant, this is the strategy. I think he used to do this strategy a lot. On the other hand, I have often found out that I try to find out a low vol regime. In this day, the selling option is in fashion. So it is a good idea for you to be in the opposite side of the trade. Right?
Yeah, why not? Yeah.
So in the DLF is, for an example, best example. You find out a low vol stocks. NMDC is definitely one stock which I buy more often. It's a liquid. So you buy straddle and you scalp a theta. How do you scalp a theta? There are a lot of theory around it. The simplest move is you put a sell order and a buy order and a sell order 1.25% away from the previous close. So what it means a previous close was 100. Then what you do is 1.25% over, you will start the underlying, and 1.25% you will put the buy order. If the underlying moves and if it having a certain move, then your short sell will get triggered and your delta will neutral and you will have a positive vega. And all you have to do is you have to get this kind of 4 or 5 moves in a span of 10 days in order to compensate with theta will, and it will be profitable trade for your long haul. Now this is just a pure indicative data. If I would have given you this in terms of the structure and all, then it would have been very different. But buying a straddle is definitely a good trade in the time where you're giving yourself a lot of time. And second,
plus I think something that I'll give you an example of the kind of trade on long haul we did on the last earnings. But what you also need is just low vol by itself. I know we keep talking about volatility being mean reverting, but volatility by its nature is also sticky on the downside, right? Volatility spikes are generally more easily mean reverting. Volatility can stay low for extended periods of time. So just because volatility is low doesn't mean you go in and buy it, right? You also need some form of catalyst that basically causes vol to increase, right? That needs to get bent, or that needs to be a big price move for volatility to move, right? And I'll give you guys an example of one of the trades that both me and Prashant did in June and July, right before Q3 earnings. So this is just around the time when GreeksCap was being formed, and we were basically discussing strategies. And Prashant was looking at Implied vol, which was trading at historically low levels. It had probably not traded at that level in like years, right? I mean, our data was showing that it's the lowest vol in almost 2 or 3 years. And Prashant was really excited about buying vol, and me and Vishesh basically looked at him and said, just wait, because there is no particular reason for Implied vol to increase in the month of June, because the earnings are in July. There's a natural reason for why vol will increase, right? So Prashant had that trade, I think middle of June, right? Middle of June through all of June. And he had a lot of theta decay that he had to keep scalping and making money. I think he ended up scratch right on the trade. And then me and Vishesh basically loaded up the same trade for July on the long side.
Simple logic.
And yeah, because we knew that vol, which is trading at 25, 30, is going to go to 40 right before earnings. Because we showed you that chart and it spikes to 40 right before earnings every single time, right? There's not, I mean, it doesn't make a genius to know that it's going to go to 40. So when I put that trade on, right, clearly I had about 10 days of data, right, because I put on the first day of July. Earnings was somewhere around the 11th or 12th of July. So I had about 10 days of trade left. Now the question is, could I have gotten it a little later? Yeah, I mean, we could have. But what happened was, it was trading on 1280 back then, and I bought a 1280 straddle. I paid about 45, 50 bucks or something like that for it.
I had the 1240 straddle, and I did make the move from 1240 to 1265.
So I had the same move, right? And from 1280, the stock went up to 1320, right? So it essentially paid for my entire straddle premium. What happened was, because I was long options, right? My 1280 call was deep in the money, allowed me to basically sell a future against it to normalize my deltas again. So I sold a future, right? And then it came back down $6, and I basically covered it back to basically bring my deltas to where it was. and I kept scalping. This is what we call gamma scalping. You keep adjusting your deltas to bring it back down to delta neutral. And I did this trade, the gamma scalping about 6 or 7 times in the span of about 10 days. And I collected, it was also about 600 a lot, right? So on every 6-7 rupee move, I make about 4 grand, right? So I ended up making 7 or 8 of these, and I ended up with 30 grand profit on just the scalping. And at the end of the day, just before entry earnings, when vol went up to 40, the straddle that I had bought for 45 or 50, I sold for 45.50. So I didn't make anything on the long straddle, but it's the gamma scalping that allowed me to basically make money on the trade. So a lot of times, just because vol is low and you buy it and vol does increase, a lot of times that increase in vol is only offsetting the trade up in that you have. So if you don't gamma scalp and you hold the trade for 10 days, at the end of it, you'll probably be like, what the hell, I was buying vol did increase and I still didn't make any money. That's because you got to pay for the trade up bill. And the beautiful thing about this is that right before the big event, Infosys is not going to, or for that matter, any underlying is not going to have a crazy move up or down. It's going to keep mean reverting. It's going to keep going up and down, up and down. So you get a beautiful chance to gamma scalp around your position. And so hopefully at the end of that period, if you gamma scalp enough, all your profits will essentially end up from the gamma scalp.
Yeah. So okay, my turn. My favorite straddle trade. I'll talk about 2. That one that Alok mentioned on Infi, and then the one nasty trade on Bank Nifty all through June, where we had I think 4 expiries at 26,500.
Yeah.
We're gonna have one more. Are we gonna have one more tomorrow? So we had this was I got into this trade in early June. We were trading at 26,500. And I bought the July straddle, the July monthly. It was the 60 days out July monthly straddle for almost $1,000. And Bank Nifty had just moved huge, almost $1,000, getting to 26,500. And our expectation, and the walls are very low. Our expectation was that the move, this kind of move is going to continue, or the walls are going to go up. None of that happened. The walls stayed low through June. But what we did see was that there was a lot of moves within the week, 300 to 400 point moves away from 26,500 and then back to 26,500. So in that trade, $1,000 of premium that I paid for that strategy, I was able to collect about 450 points of theta decay on just scalping these moves, 300 to 400 points up and down. And then the last 2 days of the July, and this was through the entire month of July, half a month of June, entire month of July. And then the last 3 days of July expiry, we go up to 27,500, right? So we have that huge move at the very end. So all those guys who are buying those the straddles at the beginning, they eventually pulled that the underlying out to the break even for that straddle. And the trade was unwound actually for a profit. And I would never think that would be possible.
And the thing is that Prashant wasn't even doing this full time. He was actually in Switzerland or wherever the hell he was. And I was getting daily messages on our Telegram channel. How much did you scalp? I scalped 20 points. I scalped 30 points. But today was a good day. I scalped 200 points. I was like, what? You're sitting out there in the middle of nowhere and kind of scalping the shit out of the bank.
And maybe some other time we'll put on the structure of how we do the scalping. Vishwesh mentioned some techniques on that. And there are some details on how much of gamma to use and how to position your size so that
in fact, in Mumbai, I mean, we all are from Mumbai, and in Mumbai there are dedicated desks who are just gamma long. And you would be very surprised the way they trade Straddle and the way we trade Straddle.
So just I told you guys I was working the commodities desk in Houston. Some of the sharpest guys I know would never ever have a short wall on their book. No matter where the underlying is, no matter where the volatility is, they would always structure their book to be long gamma, long wall. I mean, and they trade the living daylights out of that long position. They would gamma scalp the living daylights out of it. But those guys were, it's just amazing because they knew they had well-defined risk on their books. They knew they were never going to lose more than X amount of money, and that gave them the ability to take on some serious size and trade around their positions. So
the ability to scalp
is amazing. I mean, it's truly an art rather than a science. It's not something that you can teach somebody. We can teach you the basics of how to do it, but when to do it, in what size to do it, how do you position size your trade so that you have some gamma or gives you an equivalent of a lot to hedge or gamma scalp is something that comes from experience. It comes from trading these markets day in and day out. So it's not something that's easily learned. It's really an art more than a science.
Okay, so I think with that we'll end our section, and we'll take questions. So you guys can just post all your questions that you have, and then we'll try and answer them. So go ahead and just post whatever questions you have in the chat window. And while these,
it's easier for them to kind of ask questions rather than
Bala.
yeah. I think all of us. So Bala asked the question: if there was only one book for options that you would recommend, which one would it be? I think there's just consensus in this whole room. It's right here.
It's right here. It's a Bible. It's on our desk.
So I really fault Alok for using this as his mouse pad. But this is the book.
Every morning I come in.
No, his mouse is always on the long side.
It's like I've always got my hand on it, saying, "I swear to you, I'll always be right by you."
So this is Sheldon Nakenberg's book, and it's a prized possession of Alok because he has Sheldon Nakenberg's autograph on that book. So the book once again is Option, Volatility and Pricing by Sheldon Nakenberg. So you read that, pick that up, and just read it in your free time.
It's the only book you'll ever need for the option.
It really is.
If there's nothing else you read from that book, just read chapter 4. Once you read chapter 4, everything you want to know about options is going to be done, right? I mean, that's the chapter of volatility, by the way.
Okay. So there's another question from Nair. Have you some Python system for live IV?
No, I don't.
Okay, so we're using a lot of different tools for looking at IV. Each one uses different tools, and you can there are free open source tools that you can look at. I don't want to name any particular ones, but there are several online that you can go and find out. And of course, if you are trading full time and every minute you need IV calculations done, then it's always better to go and pay for several tools that you can use for your trading for those, and not rely on the open source ones. Nikhil asked a question: can you give an example of gamma or theta scalping you did on your long straddle trade? We talked about a bit of that, Nikhil, and we'll let that be at that. Where do we get IV and HV charts? So we have tools that Alok has built on Python and to construct the chart that we showed you, and those are tools that are inbuilt.
We are not very aware about is there any actual tool available right now.
Yeah.
Honestly speaking, we have not seen it.
So like a MyFNO does have some, right?
Yeah, but no, it doesn't have comparison of IV and HV. There are values of HV historical and so on, but those kind of charts are not there. Which tool is used for back testing the hypothesis? Again,
Python. So Python is the language in which we do most of our analysis and back testing. And so MySQL is the database. So a lot of our data resides on a cloud, on a web server. So it's just a matter of writing some basic SQL queries, bring the data in Python, and then doing a lot of.
So I think first step towards all this thing is you start building your some skill set, right? I think even Excel VBA.
Yeah, Excel VBA is great. That's where I started out, right? I mean, the thing is, Excel has its limitations in terms of the kind of things you can do, the kind of data that it can handle, the amount of data it can handle. But yeah, I mean, so the guys that we were talking to who do exclusively all their analysis in Excel, right? I mean, the OTs were doing that, and they were doing a fantastic job, right? So it's not so much about Python or Excel or whatever, right? I mean, it's just a matter of your comfort level and what you're good at, right? So speak to what you're good at. I mean, just take a very simple example of writing a simple web query in Excel. Then you just pull NSE's option data into Excel and then kind of start doing analysis there.
So I think Excel, Bala, your question, what APIs? So there are a couple of APIs available depending on the vendor you use. But the NSE Pi is definitely one library you can have a look at. It will give you a good edge if you're starting it out.
APIs we use to download.
There was another question.
Okay, just on that note, Bala, just be very careful with the NSE Pi API because it's not be very careful of using historical data there because it's not clean, right? So that's one note. I've used NSE Pi and I've had problems with just the data. So that's why, like I said, Vishwesh said, I like to have my own clean data set and do everything in-house rather than depending on all these external tools. A web link where we can use live scenario analysis by changing spot or IV or changing time in days.
So PC, there are a number of them. You go and search, and
there are few that they allow you to do a scenario analysis of positions.
I mean, if you find one, you'll find actually get 4.
Yeah.
Is the library of NSC free? Do you have some details, please?
So I think regarding the data and all thing, I would like to tell you, it is a function of your own needs, I think, and what kind of trader you are. So first of all, you have to define that I am the kind of trader who is going to rely on the data, and this is my data need, and this is the availability of the data, and this is how I'm going to build it. So I think first you have to answer that, and probably then you will start working. And I'm sure then it's about developing the skill set, and probably. If I have to tell you, it takes a time for you to develop the skills, and it is worth though, but it takes time. It takes time. I write my code to do whatever I want to do, but then managing a data is a task. It definitely takes a lot of time.
Okay, so Nair, I don't know whether Nair is the first name, but Nair, there is no particular library specifically for backtesting. There is one called Zipline. If you can, I've tried installing Zipline, and it's a pain. It's basically Protopian's backtesting engine, which they made available for everybody to use. But for some reason, it has these very specific other libraries like Panda's 0.14 version and SciPy X version. So they've got these very
dependencies are very
the dependencies for using Zipline are so antiquated now. They haven't gone and updated it and so on. So I've tried installing it. I've never gotten around to doing it. So I just built my own, right? So it's a lot easier to just write the code to do basic backtesting. I mean, backtesting is just a matter of setting up your strategy, right? It's saying, look, I have a hypothesis that I'm going to basically buy or sell a Bank Nifty weekly option on morning straddle and then cover it in the end. And it's hypothesis. Now you have the prices, you plug it in and you run it on the historicals, and you get the number of winners, losers, and all that stuff. So it's just as simple as that. I mean, the very simple thing you could do is just use a simple moving average crossover strategy, right? That's the most common thing that, if you just go on Google and say Python code for moving average crossover, you'll get 1,000 people that have done that. Maybe take a sample of that code and kind of adjust it for what you want to do. And then that's how you start building it out. Okay, cool. Any other questions, guys? Do you conduct any classroom training? No, and I don't think we will. Thanks for feedback. Yeah, I think these webinars might be. We will probably do more of these going forward. I think there's a lot of value that the
for us, the biggest problem right now, I mean, if we try to, it's very difficult to find the kind of people who have a similar webinar. You need to match stats, programming, and then interest in the market, and that was the option. That also the kind of work we do. So that sample size is definitely kind of small, but definitely we will do more. Are you in favor of selling 5 rupees options on expiry? Save me from that kind of thing, I mean, we would shy away from making comment, but I'm sure there is a strategy around it. A lot of the smart people are doing, and if they are consistently successful, I'm sure there is a logic to the kind of the noise it may seem. So I'm sure more than the selling, there is a lot of amount of adjustment preparation with them, and they are very fundamentally and probably account wise, capital wise, they are prepared. So it is not that simple that it may look. It is not that stupid. Also, if people are doing successfully, I'm sure there is logic to it. So I guess, that was from our side. Soon we're gonna have another session by our next expert joining all the way from Kolkata.
Yeah. So just to wrap up, I want to just thank all you guys for once again for donating to the Kerala flood relief, and I'm sure we collected close to 3 lakh rupees from this effort. All you guys, donating for this. And we really appreciate what you guys have done, and just spreading that information, spreading the awareness of the troubles that of our brothers and sisters back in Kerala went through that ordeal. I think a lot of you guys might not have been able to attend or weren't able to be part of this seminar, but you guys shared the need for donations, and that I'm sure has gone a long way. And there are some numbers that came out on the Kerala Chief Minister's Fund, and they've collected a huge sum. And one of the things I heard from a fellow trader in Kerala is that the government is actually in Kerala is actually pretty good at utilizing those funds there. So that we got to do our job and leave it to them and trust them for doing theirs. So thanks a lot for everyone for joining in. What we're going to do is take a short 5-minute break while we just set up Dharamchand Sethia, who's a prop trader, a full-time trader from Kolkata. who trades options for his prop desk, and he's going to talk about options interest, options open interest, and how that can be utilized for options trading. So we'll be back in a short while.
Somebody seriously asked, are you in favor of selling private options on Friday?
Yeah.
Guys, please don't do that.
Well, Vishwesh had a very good answer to that, and so yeah, we'll close at that. Yeah.
Pause.